There is an institution in America more powerful than any president, any corporation, or any army. It can create trillions of dollars out of thin air. It decides how expensive your mortgage is, whether your boss can afford to hire, and whether your savings grow or wither. When it speaks, markets around the entire planet tremble. And yet most people have no idea how it actually works. This is the Federal Reserve, explained from the very beginning. And once you understand it, you'll never see money the same way again. To understand why the Federal Reserve exists at all, you have to go back to a time when America didn't have it. Believe it or not, for nearly 80 years, the United States, the rising industrial giant of the world, had no central bank whatsoever. And the result was chaos. The economy lurched from one devastating banking panic to another in 1873, in 1893, and again and again. Each time, banks collapsed, savings vanished, and ordinary families were ruined. The system had no safety net at all. Then came the crisis that changed everything, the Panic of 1907. A failed attempt to corner the copper market triggered a wave of fear that swept through New York's banks. Depositors lined up in the streets, desperate to pull out their money. The entire American financial system was days from collapse. And here's the astonishing part. It wasn't saved by the government. It was saved by one man, a private banker named J.P. Morgan, who locked the city's top bankers in his library and forced them to pool their money to stop the panic. Let that sink in. The world's most powerful economy had just been rescued from ruin by the personal fortune and willpower of a single private citizen. Washington was horrified. What would happen next time, when there was no J.P. Morgan? Everyone agreed the nation needed a permanent institution, a lender of last resort, that could step in during a panic and stop the dominoes from falling. The question was what that institution should look like. And the answer was born in secrecy. In November 1910, a group of the most powerful men in American finance boarded a private railcar under false names, pretending to be on a duck hunting trip. Their real destination was a secluded island off the coast of Georgia called Jekyll Island. There, in total secrecy, they spent days designing the blueprint for an American central bank. The secrecy wasn't for fun. They knew that if the public learned Wall Street bankers were designing the nation's money system, the plan would be dead on arrival. After years of political battle, the plan became law. In December 1913, President Woodrow Wilson signed the Federal Reserve Act, creating the Federal Reserve System. And its design was a uniquely American compromise. Not one central bank, but 12 regional Federal Reserve banks spread across the country, overseen by a board of governors in Washington. Part public, part private, independent from politics, but accountable to Congress. A strange hybrid creature, built to be powerful, but never fully controlled by any one group. And here's a detail that fuels endless confusion. Who actually owns the Federal Reserve? Technically, the 12 regional reserve banks issue shares to the commercial banks in their districts. Banks are literally required to buy in. This is where the myth of private ownership comes from. But these shares are nothing like normal stock. They can't be sold or traded. They pay a fixed dividend capped by law, and they come with almost no control. The real power sits with the publicly appointed Board of Governors in Washington. It's ownership in name, not in power. So what does this institution actually do? At its core, the Federal Reserve has one gigantic job: managing the supply of money in the American economy. Congress has given it two official goals, known as the dual mandate. First, keep prices stable, meaning keep inflation low and predictable. Second, maximize employment, meaning keep as many Americans working as possible. Every decision the Fed makes is a balancing act between these two goals. And its main tool for that balancing act is the most important number in the world. That number is the federal funds rate, the interest rate the Fed controls. Think of it as the master price of money itself. When the Fed lowers this rate, borrowing becomes cheap everywhere. Mortgages get cheaper, business loans get cheaper, credit flows, spending rises, and the economy speeds up. When the Fed raises the rate, borrowing becomes expensive, spending slows, and the economy cools down. One number, set by a small committee in Washington, ripples out into every loan, every paycheck, and every price tag in America. The committee that sets this rate is called the FOMC, the Federal Open Market Committee. It meets about 8 times a year in Washington, behind closed doors. And when the meeting ends, the entire financial world stops and holds its breath. Traders freeze at their desks. Algorithms stand ready. Because at exactly 2 o'clock, the decision is announced, and a single sentence, sometimes a single word, from the Fed chair can send trillions of dollars flowing in one direction or another within seconds. No other institution on Earth moves markets like this. Now here's where the Fed gets truly mind-bending, the part most people never learn. Where does the Fed get its money? The answer: it creates it. Out of nothing. When the Fed wants to inject money into the economy, it simply credits banks with new digital dollars that did not exist a moment before. No gold is mined. No taxes are collected. A few keystrokes, and billions of new dollars are born. This is the extraordinary power of a modern central bank. The power of the printing press, without the printing. This power was used on a scale nobody imagined possible during the crises we've covered on this channel. In 2008, as the financial system collapsed, the Fed created trillions of dollars to buy bonds and toxic assets, a policy with the bland name of quantitative easing. In 2020, when the pandemic froze the world economy, the Fed did it again, even bigger and faster. Its balance sheet, the pile of assets it holds, exploded from under $1 trillion before 2008 to nearly $9 trillion at its peak. Nothing like it had ever happened in history. How does that money creation actually work? The mechanics are worth 30 seconds because they demystify everything. In quantitative easing, the Fed goes into the market and buys bonds, government debt, and mortgage securities from banks and investors. It pays for them with newly created reserves, fresh digital dollars appearing in the sellers' accounts. Those sellers now have cash to lend and invest. Interest rates across the economy get pushed down, and money flows. Reverse the machine, selling bonds or letting them expire, and you get quantitative tightening. Money drains back out and vanishes. The Fed also runs a quieter, older tool, the discount window, its role as lender of last resort. When a bank faces a sudden rush of withdrawals, it can borrow emergency cash from the Fed instead of collapsing. You saw this in action in March 2023 when Silicon Valley Bank imploded in a lightning-fast digital bank run. The Fed instantly opened emergency lending programs, and the panic that could have torn through hundreds of regional banks was smothered within days. Exactly the machinery designed after 1907, doing exactly its job a century later. Why would anyone design a system this way? Because the alternative, as history brutally proved, is worse. Remember the Great Depression. When the banks collapsed in the early 1930s, the young Federal Reserve stood by and did too little. The money supply shriveled, prices spiraled downward, and a stock market crash turned into a decade of misery. Economists, including Ben Bernanke himself, later concluded the Fed's failure to act was a key cause of the Depression's severity. That mistake haunts the institution to this day. And that haunting explains its modern behavior. In 1987, when the market crashed 22% in a single day on Black Monday, the Fed under Alan Greenspan immediately flooded the system with liquidity, and the crash never became a depression. In 2008 and 2020, the Fed acted with overwhelming force for the same reason. The institution is, in a very real sense, an apology for 1929, permanently determined never to repeat the one mistake that defined it. When a system burns, the Fed is the fire department. But this firefighting power has a dark side, and it's called moral hazard. If banks and investors know the Fed will always ride to the rescue, why be careful? Critics argue that every rescue teaches Wall Street a dangerous lesson. Take huge risks, keep the profits, and let the Fed clean up the wreckage. Some economists believe the easy money that followed each rescue helped inflate the next bubble, the dot-com bubble, the housing bubble, and beyond. The fire department, in other words, might be quietly encouraging arson. The other great danger of money printing is the one you feel directly: inflation. When the Fed creates too much money, or keeps rates too low for too long, more and more dollars end up chasing the same amount of goods, and prices climb. After the massive pandemic stimulus, inflation in America surged to its highest levels in 40 years. Groceries, rent, gas, everything jumped. And suddenly, everyone in the country was reminded that the Fed's decisions aren't abstract. They show up in your shopping cart. When inflation rages, the Fed has one brutal medicine: raise interest rates hard. And history's most dramatic example is the Volcker Shock. In 1979, with inflation running wild, Fed Chairman Paul Volcker jacked interest rates up toward 20%. It worked, inflation was crushed. But the medicine was agonizing. The economy plunged into recession. Unemployment soared past 10%, and furious farmers blockaded the Fed's headquarters with tractors. Volcker was hated at the time. Today, he's celebrated for saving the dollar. That is the Fed's eternal dilemma. That dilemma has a name in economics: the trade-off between inflation and unemployment. Raise rates to kill inflation, and you risk throwing millions out of work. Cut rates to boost jobs, and you risk letting inflation eat everyone's savings. The Fed is forever walking this tightrope, trying to engineer what's called a soft landing, slowing the economy just enough to tame prices without crashing it into recession. It is one of the hardest balancing acts in the world, performed with imperfect data, in real time, with no second chances. Now, who actually runs this machine? The Fed is led by a chair, nominated by the president and confirmed by the Senate for a 4-year term. Names like Greenspan, Bernanke, Yellen, and Powell have held the seat, and each became, arguably, the most economically powerful person on the planet. But here's the crucial design feature. Once appointed, the Fed is meant to be independent. The president cannot legally order the Fed to cut rates, and that independence is not an accident. It exists for a very good reason. The reason is simple. Politicians love easy money. Every leader facing an election wants low rates, cheap loans, and a booming economy on voting day, even if it means runaway inflation later. History shows what happens when central banks obey politicians. In the 1970s, pressure from the White House helped unleash a decade of double-digit inflation in America. In countries where the central bank became the government's personal piggy bank, like Zimbabwe or Venezuela, the currency was utterly destroyed. Independence is the firewall between money and politics. And that's exactly why you constantly see tension between presidents and Fed chairs, played out in headlines and press conferences. Presidents publicly demand rate cuts. Fed chairs politely refuse to be rushed. Markets watch every word of the drama, because the stakes are enormous. If investors ever conclude the Fed has become a political puppet, confidence in the dollar itself could crack. The independence of the Federal Reserve isn't just an institutional detail. It is one of the invisible pillars holding up the entire global financial system. Because here's the thing, the Fed isn't just America's central bank. It is, in effect, the central bank of the world. The U.S. dollar is the global reserve currency. Most international trade, most global debt, and most central bank reserves are in dollars. So when the Fed raises rates, it doesn't just cool the American economy. It pulls money out of every corner of the planet, straining emerging markets from Asia to South America. When the Fed sneezes, the world catches a cold. No election abroad, no parliament overseas gets a vote. Naturally, an institution this powerful attracts dark theories. The Fed has been accused of being a secret private cartel owned by shadowy banking families, plotting behind closed doors. The truth is less cinematic but still remarkable. The Fed's profits, and it earns billions, are handed over to the U.S. Treasury every year. Its leaders are publicly appointed and grilled by Congress. Its decisions are published, its minutes released. It's not a secret conspiracy. It's something stranger, an immense, unelected power operating in plain sight. That phrase, unelected power, is at the heart of every serious debate about the federal. A handful of appointed economists decide the fate of mortgages, jobs, and savings for 330 million Americans, and by extension, billions of people worldwide. Supporters say that's exactly the point. Money is too important to be run by vote-chasing politicians. Critics respond that no democracy should hand that much power to people nobody elected. Both sides have a case, and the debate will never fully end. So let's bring this home. How does the Fed actually touch your life? Personally, start with your home. When the Fed hikes rates, mortgage rates climb within weeks, and suddenly the same house costs hundreds of dollars more per month. Your credit card interest follows the Fed's rate almost directly. Car loans, student loan refinancing, small business credit, all of it dances to the Fed's tune. You may never visit Washington, but Washington's most powerful institution visits your wallet every single month. It touches your job, too. When the Fed tightens hard, companies cut back, hiring freezes and layoff spread. That's the whole point of cooling an overheated economy, painful as it is. And it touches your savings and investments. Low rates punish savers. Cash in the bank earns almost nothing and push everyone into stocks, inflating markets. High rates reward savers again, but hammer stock prices. The great waves of the stock market over the past decades, the booms and the busts, have the Fed's fingerprints all over them. Wall Street even has a nickname for the Fed's rescue instinct, the Fed put. In options trading, a put protects you from losses. Investors joke, half seriously, that owning stocks comes with invisible insurance because if markets ever crash hard enough, the Fed will always ride in with rate cuts and liquidity. For over 3 decades, that bet has mostly paid off. But it raises an unsettling question. What happens on the day the Fed can't ride to the rescue? Because inflation is raging at the same time the market is crashing? So let's pull out the money lessons because understanding the Fed is a genuine financial edge. Lesson 1. Never fight the Federal. It's the oldest saying on Wall Street for a reason. When the Fed is cutting rates and pumping money, markets tend to rise, and fighting that tide is expensive. When the Fed is aggressively hiking, caution pays. You don't need to predict the market. You just need to pay attention to which direction the most powerful financial force on earth is pushing. Lesson 2. Inflation is the silent tax, so build your life around real assets. The Fed itself targets 2% inflation per year, meaning your cash is designed to lose purchasing power slowly, forever. Over decades, that quietly devours idle savings. The defense is owning things that grow or produce. Stocks, property, businesses, skills. Cash is for emergencies and opportunities, not for storing a lifetime of wealth. The system practically announces this rule out loud. Most people just never listen. Lesson 3. Watch the Fed's words, not just its actions. Markets move on expectations. A single hint from the Fed chair about future rate cuts can rally markets months before any cut happens. That's why every speech is dissected word by word. You don't need to trade on it, but when you hear the Fed shifting its tone, hawkish toward fighting inflation or dovish toward boosting growth, you're hearing the weather forecast for the entire economy. Your mortgage, your job market, your portfolio. Lesson 4. Crises are when the Fed shows its true face, and that face has always been the same since 1987. Flood the system. Stop the panic. Knowing this changes how you behave in a crash. The investors who panic sold in 2008 and March 2020 locked in devastating losses. The ones who understood that overwhelming Fed intervention was coming and simply held on, watched their portfolios recover and soar. In every modern crisis, betting on the world ending has been the losing trade. Step back, and the Federal Reserve is one of the strangest inventions in human history. A committee of economists meeting in a marble building in Washington, conjuring trillions from nothing, steering the fate of nations with a single number. It has prevented depressions and fueled bubbles. It has saved the system and been blamed for rigging it. It is neither the villain of the conspiracy theories nor the flawless guardian of the textbooks. It is a profoundly human institution, wielding almost superhuman power. And its story is far from over. The Fed now faces questions its founders never dreamed of. Should it issue a digital dollar? Can it keep inflation anchored in a world of massive government debt? Will its independence survive an era of raging politics? Whatever the answers, one thing is certain. The decisions made inside that building will keep shaping your money, your work, and your future, whether you pay attention or not. And now, unlike most people, you actually understand the machine. So the next time you see a headline that the Fed raised rates, or hear the markets holding their breath before a Fed meeting, you'll know exactly what's happening behind the curtain. The panics of 1907, the ghost of 1929, the printing presses of 2008 and 2020, the eternal tightrope between inflation and jobs, it's all there in that one announcement. The most powerful bank on earth is hiding in plain sight, and understanding it is one of the smartest financial moves you will ever make. If this finally made the Federal Reserve make sense, then this channel is exactly where you belong. We break down the biggest money machines, crises, and stories in history, the crashes, the bubbles, the fortunes, and pull out the lessons that protect your own wallet. Subscribe to Money Stories, ring the bell, and tell me in the comments, do you think the Fed has too much power or exactly the power it needs? See you in the next one.